Welcome back. Our next guest says that volatility in the market should calm down after seeing a phenomenon he dubs as backwardation. So what should investors focus their attention on? Scott Bauer, senior market strategist at Trading Advantage, is joining us now from the trading floor of the Chicago Mercantile Exchange. Where should, Scott, the attention of investors be focused right now?
Well, fortunately, at least for the short run, the Washington debacle is behind us, and I know that's going to be out there in the next 3 months or so. But now, this week especially, we can focus on corporate earnings, as about 25% of the entire S&P 500 reports this week. And quite frankly, tomorrow's jobs number is going to be pretty important. We haven't seen it in quite a while because of the government shutdown. So that number, in my estimation, is just going to reinforce that tapering is off the table at least through the end of this year.
Let's talk a little bit about, you were looking at a report that said 40% of consumers curbed their spending during the shutdown, and you think this doesn't bode well for the holiday season. Of course, the U.S. economy, 70% consumer-based. What is it all, how do you put it all into one picture?
You know, it's kind of a give and take here, because I do think that corporate earnings are going to be strong. I do think that the economy is picking up. But the bottom line is, because of the dysfunction in Washington and because of the doubt that Washington has put in consumers' minds, like you said, 40% of the consumers that were spoken to in this report are concerned this is going to happen again, are concerned, what if there's another shutdown? What if they can't get the budget straight again come February of next year? And that, in my estimation, is the one overriding fear of this marketplace, because if you get these consumers that don't spend money, especially coming into the holiday season now, that can trump everything else. That can trump great earnings, that can trump good economic numbers, and that can really set us back. So in my world, it is imperative, absolutely imperative, that before this holiday season, the dysfunction in Washington stops and they can come to some agreement that doesn't put us in this same hole again back in February, or out in February.
What's your view of the earnings that we've seen so far from U.S. companies, the banks in particular?
Pretty mixed. I mean, the banks actually look pretty good. And what I do like about the banks is they were really the impetus behind the rally pretty much all year. I mean, they really had some solid footing. And we're seeing decent earnings out of the banks. And given all of the trouble in the financial sector, and obviously with J.P. Morgan and now Wells Fargo is there's a story about them being sued. I think the banks have held up particularly strong and probably will lead the rally going into the end of the year, as long as the Washington dysfunction doesn't override everything else again.
So bring us back to where we started with the backwardation idea, the short-term volatility trumping longer-term volatility, which is unusual. And we were talking to some options traders and how they were setting up for this. How do you see this playing out in the market, in the positions being taken?
Well, as you said, this backwardation phenomena, which happened over the last couple of weeks, what that really meant is short-term volatility, and in the traders' world, short-term volatility means it can mean a day, it can mean a week, was much higher than volatility going out. That is not the norm. About 85–90% of the time, it's the opposite. Short-term vol is, where it trades, and future volatility is higher. So this phenomenon leading into the last week's agreement on the budget, the pressure was really on short-term vol. And what that told us is that if a deal was struck, we were going to see that flip around towards what's called contango, or a more normalized volatility structure. Well, we've seen that happen. So the short-term vol, after we saw the budget agreement last week, absolutely got hammered. And now the longer-term vol, going out to December, January, especially in February, which is the next deadline, that has now picked up. So that's why we've seen the VIX in just the last week drop from about 21% down to about 13% where it's trading now. I mean, just unbelievable decrease all based on the settlement or the proposed settlement in Washington. If that phenomenon happens again, which we may see it again come December or January, the closer and closer we get to that next deadline, watch out for that big spike again in the front-term volatility as compared to, at that point going out in March, April, May. That may happen again.
Thanks a lot, Scott, and have a great day.
Same to you. Have a great day.
That was Scott Bauer. He's senior market strategist at Trading Advantage. He joined us from the floors of the CME in Chicago.